that time, whenever our economy tanked, guess what happened around the world? Everybody's economy tanked. I mean, everybody. Europe was in trouble because Americans weren't buying as much. America has the largest population of consumers. In Canada, there's only barely 30 million people. That's like New York and New Jersey area has more people than all of Canada. What I'm trying to say is this, that a lot of times whenever people think that, oh my God, the American economy is not doing well, guess what happens? Every single economy in the world, from the first world countries to the second world countries to the third world countries, like an economy like China, economy like India, a lot of the jobs there are dependent on what happens in the United States of America. And so today we live in a world where the world has shrunk. And this whole notion that a lot of times people believe, oh my God, there's going to be a big problem here and everybody else is going to do better. Guess what? They're not. They're going to suffer equally, if not worse. I mean, think about a pyramid. If the people on the top suffer, that means that the people who are on the rung below and the rung below and the rung below, they get even more oppressed. I'm not saying that it's, I'm not trying to be rude, I'm not trying to be crass, it's just the reality of how the world goes around. And so I always have to laugh whenever a lot of times people are like, well, they wish poorly for America, and doesn't matter where you live, guess what's going to happen? Your economics is going to get affected if it affects America. Now, how does that come back to us as real estate investors? What I mean by that is this: a lot of people are worried about a lot of debt that we have. A lot of countries, including China, including India, including Europe, a lot of countries have a tremendous amount of debt, and they're going to print their way out of it. China does it already by controlling the currency. India it does it all the time because it has 15, 16, 17% inflation. They won't admit to it. They say 6, 7%, but it's if you go buy something there. So these are the big places that in general, the quality of life for your middle class has been going up consistently. Yet they all get affected because of the United States. So if the United States has a debt problem, guess what? China and India have a problem. I say that to say this on the economics of it, that in general in the United States, we're all at this point pretty much connected because of the economies. And what happens is if we get affected, the entire world is going to get affected. And I'll kind of address this issue a little bit later. There's a video that I think you guys should watch. It's a wonderful, wonderful video, but I'll kind of address that issue later, because at some point we will have another 2007, 2008, that will come. That's an economic upturn and downturn, and those things come, and the governments have to do bailouts. A lot of countries have been through it, and so is the United States. And just happens to be that we are the best of the worst. So just understand that. That doesn't matter what you say about the United States, still this country is the most stable. We have our problems, we have a lot of issues. Yet, I believe if you look at the world economics, this country is the most stable still compared to a lot of other places. What has happened is when, let's say, President Bush was in power, when President Obama was in the office, and now it's Trump, it doesn't really matter. There was a reason why a lot of people jumped on Bush's bandwagon because they couldn't stand him. Then the Republicans jumped on Obama's bandwagon because he was going to drive us down the drain. And now it happens to be Trump. A lot of this is all politics. And a lot of this is today, the news media, nobody's buying newspapers. So they have to gin up all the time some kind of a crisis, so that what happens is that basically people keep watching the news and keep tuned in. If they don't have fear, and if they say economically we're doing a little bit better than we did last year, a little bit better, that's not a news. Most people listen to doom and gloom news. That is what we are all attracted to, unfortunately. That's just how human beings are built. So understand why the news media. It doesn't matter if you like the administration, you don't like the administration, that's a political issue, right? But that has nothing to do with the economics of the whole country in general. So I just wanted to kind of bring that forth. The second thing what you'll feel, what you will always see referred to is what is called the times of when things go up and the times when things go down. This chart that I have on the screen right now is called the CaseShiller Index. The Case-Shiller Index happens to be he was a Yale economist, Robert Shiller, and Case was another guy who was his partner. Over the years, since 1890, they've been tracking housing prices in the United States. If you see, a lot of times people will compare housing prices to what happened back in the Great Depression, which is from 1930, and it lasted, it's supposed to be actually 33, but it lasted all the way, according to most economists, all the way through about 1940. Then there was another recessionary period between 57 and 68. Then there was another recessionary period, they say, in the 80s. There was another recessionary period, which is somewhere around 89. So what they say is every 8 to 9 years, that period repeats itself and real estate housing prices go down. So what the correlation in the marketplace and what they're predicting today, the reason I'm bringing this up is what they say is since 2010, prices, or 2011, whenever you want to kind of benchmark it, from that time till today, we're about 7.5, 8 years into it, and then the next kind of downturn is due. Now, downturn in real estate a lot of times doesn't happen because of what happens in real estate. It may be because what happens in the stock market. It may be because of what happens in some other industry. And because the mood of the general public changes, everybody becomes scared, right? 9/11 happened. We all were like, oh my God, what happened? Right? Yet at that time, there were economic factors, which were because the government was willing to put so much money and promote housing so hard. What happened was, even though 9/11 was a catastrophic event for not only America, but for the world in general, what happened was the economy, if you look at the graph, even at that time continued. There was a blip for a little bit. Prices kind of, got stuck. Nobody was buying suddenly. And then people went back. And we have short memories as Americans, fortunately or unfortunately, fortunately that we kind of forget events and we move on with life. So obviously everybody knows 2006 was the peak, and then we started coming down. That's kind of the general trend. So I want to go to the next thing. The next thing, the chart that I have is the Case-Shiller Index as it shows as of today. This was somebody that took the Case-Shiller Index, and what they're showing is, well, in 2006, the prices were up here. And now it's the second bubble is coming because the prices are here. The problem is this, and this is what I want to kind of break that down. It's the pricing is different in New York versus in California versus in Miami versus in Phoenix as it relates to Chicago. The reason I say that is if you're way out in the East Coast, if you're way out in parts of the West Coast, way up north in the Northwest in Seattle area, or markets like Phoenix, or markets like Miami or the Florida market, certain markets of Florida. There are other artificial factors that make a bubble happen in those markets at a lot faster period than we do. We tend to get affected. So if in general, if there's a crash in California, then that crash, by the time that wave gets to Chicago, there is a year, year and a half, 2-year lag time. So as you'll notice this in the next couple of the next graphs when I go through this, is that in California, the crash happened a lot quicker than it happened here. So whenever you look at a predictive indicator of where home pricing is going to go, you need to start looking at the coasts. That's the first place to pay attention to, and just look at the pricing index in general. And then I want to kind of break this down a little bit further, and we'll go into some more detailed stuff. So this is kind of what, if you do any research, you'll find a lot of news about the next bear market. You'll find a lot of news about what is happening. The way I look at the news is this, that I look at it in 2 ways. Number one is, if I'm doing flips next year as it relates to real estate, is it going to affect me? So we don't tend to do new construction, but even if a flip, let's say, gets stuck, it takes you 6 months, 7 months, 8 months to do the property. Am I in fear of a recession happening where I predict that the market is going to be at 350, and now I'm going to only have to sell the property at 320 or 300? If that's not the case, then if there is a market dip in 2 years from now, does it affect me for flips? No. So that's number one. That's a short-term play that we look at. The second play that we look at is based on our rental properties. Now, if you're doing wholesales, how does it matter to you? Does it really matter if the economy is good? Not that you should pray for a bad economy, of course. But what I'm saying is that what you have to look at is, how does the market affect you specifically? What is your investment strategy? Our investment strategy is threefold. Some properties we wholesale. So that's not dependent, as long as there's not if a catastrophic event happens that's beyond any of our control, guess what? Nobody can do anything about it. But beyond that, if the economy, let's say, comes down in the next couple of years, is that going to affect you as a wholesaler? No. Why? Because you're not even taking title to the property. You're just getting the property under contract and you're moving it out to the next buyer. So it doesn't affect you. Number two, if you're somebody who's going to do a fix and flip, the way you should look at things is that in the next 6 months, so today we're in January, it's reasonably cold in Chicago. What happens in the next 3 months? So in the next 3 months, if you have a flip coming on board, statistically, your flip is going to sell for a higher amount than what you thought it would have sold in October or November. Why? Because each year in Chicago, in March, April, May, and June, we get a bump. After that point, typically, the market cools down because the pent-up demand for that people that are looking for properties suddenly goes up in March, April, June. Why? Because of the weather, basically. So ideally, if you're going to put a flip on the market, you should put it on the market, unless it's just unreasonably cold outside, somewhere on February 15th. It'll sit on the market for about 10-15 days and then sell in March or April right away, and you will get a higher appraisal as well as a higher price for the market. And I bet you this year that's going to hold true. That has held true all the way from 2011, 12, 13, 14, 15, year over year is what we're talking about. So next, let's go to the next thing. There's a recording, which I think this is a great YouTube video. We will include a audio of this also when we send this out to you. And I think this is something that you should listen to. It's a recording between Robert Kiyosaki and Jim Ricard. Jim Ricard happens to be an economist and is a very, very, very bright guy. The gist of the recording is they're talking about something is coming, something is coming. If you notice, in the last 6, 7, 8 years, Robert Kiyosaki initially wrote the book, Rich Dad, Poor Dad, then the Cash Flow Quadrant, then a host of other books, right? This is a business. Now, the man is a highly respected author. He's done great things for the financial community in terms of real estate is concerned. But a lot of these recordings and a lot of these things that are talked about today, they're talked about from a standpoint of selling more books and more tapes. That is very different than how does that affect you? Because a lot of it is fear mongering. Now, does that mean that what they're talking about is not relevant? No, it is relevant. It is relevant in terms of understanding the economic picture and what happens on a macro level. But it's not relevant from the standpoint of going and hiding, because if you really listen to what they're saying, a lot of it is, it'll put basically the fear of God in you, and I don't think that is correct. But on the other hand, Jim Ricard happens to be a very, very bright guy and happens to speak the truth in terms of on the whole level. So I think this would be a great recording or a great video you guys might want to listen to and or watch on YouTube, and it'll relate to us. So now let's come back to the Chicago market. So when people say, well, what's going to happen in the Chicago market? So in the Chicago market, we're basically, if you take it from, say, downtown Chicago, where the post office is, right? And then you draw a kind of a radius all the way up into Antioch on the north, all the way out to, DeKalb, touching Rockford, all the way down to all of the south suburbs, and including that whole area, Moni and all that area. We are not in one market. A lot of times people think, well, the Chicago market. The Chicago market has a lot of sub-markets. What I mean by that is that in certain times, even when the markets were really bad, there were pockets in the market that were doing still well. The reason I bring that up, that when you're investing, you have to start thinking about investing as a sharpshooter rather than just doing a shotgun in the market. What I mean by that is today there are markets in the Chicagoland area where you have properties that are $1 million+ dollar properties. And they're in markets where people have basically household incomes of $250,000 to $300,000. And those properties are not selling. And there has been a seismic shift from, say, buying up in the north part of town, which is like the Lake Forest and all those areas, which were hotter than hot at one time. And yet over time, those areas have shifted. And so in the next recording, we'll talk about that. I'm not going to get into that much detail this time, but let's move forward. But I wanted to move that, kind of get into it, because that is something we will break that market by market down. So if you look at this, the Chicago by itself, there are pockets of Chicago, and this is a map that I've shown you guys. This is a map that's put out by the city of Chicago. I did not make this up. This is a map which shows what are the pockets that have lost population. So, I mean, think about some of these pockets. Some of these pockets are hot as can be if you really want to do a wholesale deal, or if you want to do a flip deal. They're hot markets, even though the population has left. Why? Because of the loss of population in those markets, there has been a ton of opportunity, which is that the property discount that you would get, let's just say in area 27, the discount that you would get. So in the, like say area which is a little bit, the Hermosa area or that area. In that area, you're going to have a hard time finding a property which has a heavy discount. Why? Because the amount of people that are moving in is a higher number. Whereas if you take some of the other markets, let's say where there has been a loss of population, 15% loss of population, you're going to find a lot more opportunities. I'm just kind of pulling something out of the hat, so don't quote me on this. I'm just using South Deering because South Deering happens to be on the south side, and it's indicated in red. 15% or so loss of population. This is from the census data. These numbers come from. So what happens is that if you're in the south side and if you want to do flips, what you do is you pick markets where there has been a loss, yet there is a high turnover. And we'll kind of do the breakdown of that as to how to identify those pockets. Now, if you're going to own a property for long term and your strategy is, I'm going to own the property forever for a rental, then you have to think about it from that perspective, is that now the next year or two is not important. What is important is the stability and the economic growth of the area for the next 5 to 10 years. So this is something just for me. I have a real estate license, so I'm not saying where you should buy or you should not buy. That's completely up to you guys. I'm just talking about from my particular perspective. I tend not to buy in Dalton. Dalton is an area I'm not going to buy. Why? Not because I don't like Dalton. I don't like the numbers that are there. And what are the numbers that I don't like is I don't like the taxes. On a property I can buy for $50,000, if the taxes are $8,000 or $9,000 on a property, that means in 4 years I have paid more in taxes than I paid for the property. So what is the economic forecast for that particular town? It doesn't have industry. The economic forecast is going to say that that town is probably not going to do as well financially, and guess who's going to keep buying there? Can they attract more and more homeowners? Probably not. They're going to attract more and more and more and more tenants. What is that going to do? That's going to drive the property prices down for you. But now, if your strategy is doing a flip, and as long as that area is moving, can you do a flip there? All day long. Because guess what? If there's another investor, you pick up the property ultra cheap. You ideally, you just wholesale the property. You get it under contract, or even if you close on it, you do a quick wholesale, make $10, $15, $20,000, and you get out of it. Why? Because you have no risk at that point. Even if you're going to do a flip, if it's a high turnover area, you can do a flip there. But just my strategy would be is, why would I want to own the property if I buy it for, say, $35,000, $40,000? I put $10, $15, $20,000 to fixing it. My all-in cost is $55,000. And then I know the taxes are so obscene that the property prices continue to fall. Then that means that 2 years from now, the property is going to only be worth $40,000. It's not economically, the area is not going in the direction that I want it to go. See, it's pure economics. It's not about buying one area versus other. What I want is I want good economics for the long term when I'm investing in a rental property. In flip, I'm looking at what's going to happen in the next year. That's all I care about, because then I'm in and out of the property. So something to think about and pay attention to. So as I said before, we tend to divide. I had said that when I wrote the email, that it's 7 areas. Actually, as I looked at my notes from the other thing and from the maps from Mastery, and some of the areas that I did not mention is, so you have the downtown market, you have the west market, Chicago, west side, you have the south side, you have the north side, you have the northwest suburbs, then you have the west suburbs, like the Naperville and that whole market over there. You have the south and southwest suburbs that get lumped. And then you have what's called far north. What I mean by that is the North Shore market is not going to be the same as the far north suburbs market. That's a different market. So you have to look at it differently, because let's say if you compare Zion and you compare that market in Zion, right? You take Zion right next to it, right south of it, I'm just having a mental block. But then you have Gurnee up there and you have certain markets. So if you take Gurnee, Zion, and all those geographically in the same market, guess what? The Zion market is very different than the Gurnee market, even North Chicago market. Even though North Chicago market has its own issues, it's certainly not the Zion market, because Zion market is economically depressed. It has the similar type of issues. 29% of the properties in that market are vacant. So now if somebody says, well, Andrew, I'm buying the Zion market, fantastic, good for you. Guess what? If you ask me, I'm not going to buy it. You're going to say, well, houses are cheap. Yes, houses are cheap. Now, if I know I can find an end buyer that I can move the property to, that's fine. But just a couple of years ago, if I have 15, 18, 20, 25% vacancy, these properties have gone dark. Nobody wants to live there. If that's the case, why would I want to buy a rental? What is the type of renter I'm going to attract? Because guess what's going to happen? The guy next door, he's going to say, oh my God, there's three properties in the block that are vacant, haven't been rented for a long time. I'm going to reduce the price. I'm going to reduce the price. So even though I may have a nice house, year over year, that house becomes less and less and less in terms of value. Because why? The taxes keep going up and up and up, because the town has to provide some basic services that they can't if they don't keep raising the taxes, because there's no economic base. Again, it all comes back to economics. So a lot of times, whenever the talking heads are talking about, they talk about employment, they talk about jobs. They can't themselves figure out if the jobs went up, if the jobs went down. But I mean, think about it this way. If you look at your own life, or if you look at, say, one of your friends, or you ask somebody, husband, wife, that have a job, is it easier today to find a job than it was in 2008, 2009, 2010? Bar none, the answer is going to be yes. In general, the companies are doing pretty well. The economic climate is better than it was. Now, it's arguable what reasons, all that kind of stuff is the political aspect of it. On the other side, think about the administratively. You like Trump, you don't like Trump, doesn't matter. But economically, you agree with the policies or you don't. But economically, the administration has a push for economics to do well. That's the general administration policy, right? And that's what's happened. The day Trump got elected, even the Wall Street guys that didn't like him, they knew that they basically said market was going to go up, and boom, the market went up, because that's a political administration. Depending on how the political administration swings, how they look at things, if the glass, they look at it as half empty or half full. That is going to determine where we head over a course of time. It's like a big ship. The other thing, what the talking heads always focus on is, well, world events. There was a nuclear thing a few years ago in Japan. And then they had these experts, how the whole world was going to end because of that. Then they had the whatever that Brexit currency, whatever that whole issue was in Britain, how that was going to, and everybody was concerned about it because they made a big hoopla about it. Guess what? Did that affect real estate prices? No. That's not what affects the prices. What affects real estate prices on the whole is that they're going to try to link any news to a depressionary type of a market. The reason they don't do it is because of malice. The reason they do it is because they get higher ratings. So more and more people are going to watch Anderson Cooper or whatever the case may be. It's no different on Fox News, and it's no different on CNN or anybody in between. It's the same thing. They're all vying for eyeballs. But what it creates is, it creates a sense of anxiety amongst us, and we're not sure about what is going on all of the time. The things that we need to look at as real estate investors personally is, number one, what is the mood as it relates to job and industry, right? Not your political feelings, but what is it in the country, because that's always going to overlay. Because we might be okay in Chicago in terms of our pricing today, but what is going to happen 2 years from now? If in California you have a lot of properties that are going into foreclosure, guess what's going to happen? That effect is going to tumble down, and it's going to come in the middle of the country, and it might be a couple years behind, but it is certainly going to come. Number two is, how do you feel about the economy? Not your political thoughts, but economy. Number three is the administration friendly to home ownership? I mean, think about it. We just came out of things from 2007 and 8. Already they're dropping the criteria for what it takes to buy a house. That has already started. Already there's more people, even at the RIA, there's more money on the street that is being spent to buy more and more and more and more houses. Doesn't matter if it's on the investor side or if it's on the homeowner side. Now, that doesn't mean that necessarily you start getting in your rabbit hole and hide. What you start doing is you start looking at your flips really, really, really carefully, and you start flipping as quickly as possible your average bread and butter properties. Why? Because we'll talk about that in the next part of it, as to why the bread and butter properties and the medium-sized properties rather than the bigger properties. The other issue is affordability. This is a big critical issue that we miss all the time. And this is what drives everybody. I mean, think about it. You walk into a car dealership and they qualify you based on the first thing they ask you, oh, what can you afford? Well, it's not like what can I afford? It's the issue is, should I afford? The problem is this: whenever most people are buying a property, there's slabs of people that'll buy. If people are buying a property, and this is general, I'm talking about, this is not on the whole, but in general, if people are buying a property in a C area, right? What that means is it's not quite bread and butter, but it's an area which is improving, right? If they're buying a property in that area, typically, most of the properties they buy are going to be bought with 3.5% down type of loans. And then in that particular area, they're willing to pay the maximum payments that they can afford. Why? Because their affordability is less. So it's an economic factor. You go into a B area, you're still going to have, some people that are going to buy with 3.5% down. Some you'll have maybe 5, 10%, 20% conventional loans will start showing up in that particular area because they don't want to have PMIs in that area. You go to an area which is an A area, let's just say Schaumburg area or a Northbrook area. You'll have a lot of couples that are both white collar working couples. Their qualification may be to buy a $700,000 house, but guess what? They're only going to buy a $400,000 house. Because why? Because as people start making more and more money, a lot of times people who buy in the A areas, they're not buying to the max of their affordability. So if tomorrow I walked into a dealership today, compared to where I am today in my life versus say 10 or 15 years ago, 10, 15 years ago, somebody said, oh my God, you can get a new car. I'd have been so excited and I would have gotten it because I could barely afford that. Today, if somebody says, well, Andrew, this is a great idea that we qualify you for Ferrari. Now, just because I get qualified for something, does that mean I'm going to buy it? Well, maybe if it's, if I've lost my brain that day. But just because the affordability is there doesn't mean I'm going to go do it. Today, what has happened is we haven't hit that part in the B and C markets where properties are still affordable. Until properties become unaffordable, and I'm talking about basic properties, I'm not talking about big houses, we're talking about what your average person buys. The other factor that you have to think about is how hard is it to qualify for mortgages? Still today, they're trying to get people back into home ownership. The reason I feel the market is still going to be stable is because they're not discouraging people yet from buying mortgages. They're encouraging people, so that holds up prices. They'll come up with new and grants and programs. As long as they keep doing that, guess what happens? They're staying ahead of the curve. The other issue is needs and wants. This is something I'll cover in the next recording, so I'm going to just leave that there. So when we talk about housing, don't think about housing just as one thing. Think about housing in terms of, are we talking about new construction? Are we talking about rebuilds and addition? Because mind you, when we're talking as investors, we're not talking about buying your personal residence. You can buy your personal residence at whatever price you want. It's up to you. That's got to be based on what schools you want, what amenities you want. That's what it is. When I'm talking about housing, I'm talking about it purely from an investment perspective. Either you're wholesaling, either you're flipping, or you are doing a rental. That's purely what I'm talking about. So then I'm going to categorize it. Are we talking about new construction? Are we talking about rebuilds and additions? Are we talking about resales? Or are we talking about properties that I'm buying at a discount? Now, today, clearly, if you've been paying any attention in the last 2-3 years, it's harder and harder to find properties that are highly discounted foreclosure properties. Does that mean you can't find them? No, but it still means it's harder to get them. Yet on the flip side of it, it's easier to do resales in today's market. That is something that you still have to pay attention to. I'll cover new construction stuff at a little bit later point. So where are we in terms of pricing in the Chicago market today? What they say is that we're somewhere around 2003 figures is where we are. So if you think about 2006, 2007 as the high point in the market, we're somewhere around the 2003 figures. Now, I feel that they're being a little bit more optimistic. I'm talking about the general Chicagoland area, but let's just take it as that. You can clearly see that in some of the markets, right? Some of the markets that are basically the higher markets, the prices are obviously much higher. They've gone above what they were in the 2006, 2007 type of markets. That has not happened in Chicago, not yet at least. So that's something to me that is good news. I'm going to kind of skip this. So I want to go back and I want to go over to a different slide. If you look at housing starts, right? If you look at the housing starts and this is new construction data only, right? If you look at housing starts back in the 60s to 70s and you see a general trend. With housing starts, the problem, what happens is, and I'll give you a perfect example, which is Hinsdale is a perfect example. We all know Hinsdale is a super prime area, right? And supposedly the saying goes, well, it's the rich people live in Hinsdale, right? And so in Hinsdale, $1 million house shouldn't be a big deal. There's tons of $1 million houses, and it's true. It's very true. But yet, if you pay attention to what has happened in Hinsdale, 3-4 years ago, there was no inventory that you could find in Hinsdale of properties that were $1 million plus, because guess what happened? A few years ago, there was not much building going on in Hinsdale, and any property that basically the housing starts that people had started, anything that would come on the market around that price range would sell. So they would buy the lot for about $300,000 or so. They'd put a house on it for another $400,000, and then guess what? They could sell the property somewhere around $1 million. Now, guess what started happening was a bunch of people realized that the builders that were building one house, they suddenly started building 2, 3, 4, 5, 6. And they started buying land, which was equivalently a little bit more expensive, a little bit more expensive, a little bit more expensive at the second turn. A lot of people who were doing small flips or wanted to do flips, they got into the market. They said, oh my God, look at the builder. He sold 4 houses last year, man. And the house sold for about $1 million each. I think he made 15, 20% on the property. If I do 3 of those and I make 150 a piece, I'm doing pretty good. And that mentality, what it did was, it created a glut on the market. And suddenly, when there's so many people going out there trying to buy ranches, trying to buy older homes, now that older house, same thing that you could have bought in, say, 2011 and 12 for $250 or $260, suddenly that house goes for $350 or $375 or $400 just for the lot alone. Now you go to put a house on it, labor is not available as cheaply as it was back when nobody was building. Labor prices have gone up about 15% or so. And so what happens is your end product starts hitting that $1.1, $1.2, $1.4 million mark. And not only you had this bright idea of building a house for $1 million plus, there are about 15, 20, 30 other people. And each of them only did a house or two. There's 100 houses plus sitting on the market, in that price range. And guess what? There's not enough demand for the amount of supply that came online. And that's something that you have to really critically think about whenever you think about new construction, because new construction a lot of times is a long process. It's 18-month, 2-year, 3-year process. And in that time, there's too much of a lag time that the market will change and your carrying costs are such. Now, I'm not saying that if some of you guys are builders, God bless you, great, good for you. I just feel it's much riskier, especially in the higher price ranges. So if you look at the, this happens to be a graph of the Chicago market specifically as shown by, so this is the Chicago Home Pricing Index as shown by CaseShiller from all the way from 88. This is on the web, so you can pull this up for yourself and play with it, and there's some cool things you can do with it, with the graphs and stuff. But what it shows is somewhere around 2007 was the peak in the market. And if you look at the bottom of the market, if you look at MLS data versus this data, it's going to differ by about 6-8 months. That's going to be the kind of the difference, but it's depending on, they tend to combine single families, townhouses, condos, everything into one. Whereas in the MLS, what I'm going to show you is you can separate that out, that data out all over the place. So something to pay attention to. But even if you look at today's pricing, which is 2017 pricing, even though this is kind of combination of everything, it still is nowhere close to where we were in 2007. The more important thing is this, that if you look at the amount of delinquencies, and this is something that is really, really important. What is delinquencies? So delinquencies are, I think somebody has a question. Let me see if I can answer that. Delinquencies are basically number of people that are behind on year to year, if they have basically gone under contract, right? Excuse me. If they have not paid their mortgages. So if this number, if you see this number climbing, what's going to happen is that the number of foreclosures that are coming is going to go up. Yet, if this number is going down, now this number is down to less than 1.9%. The average delinquency rate is somewhere around 2% is considered average. So if this number goes down, what's going to happen is, you know that at least in that particular year or for the next 6 months, for the next 8 months, foreclosures are not coming. This is an easy amount of data. This comes from TransUnion, so you can look this data up for yourself. If you see this data changing and if you see this data going up, predictably, we know that the numbers are going to start up. So if we go back to the MLS and you look at what has happened so far. So if you just look at, say, the Streamwood market, and I'm not going to compare the markets for today, but let's just, well, let's do this. Let's take Streamwood versus Midlothian. I think this would be a good comparison. So if you take, say, Streamwood market, so this is, the red is going to be the entire MLS market, right, where things were. And in 2008, mind you, they had already come down significantly, right? Now, if you see, in general, what you see is that basically in all three, for the entire Chicago market, for the for Streamwood market, right, the bottom pricing was somewhere around, on an average, and this is it all properties? Let me make it resales. So I'm doing all price ranges, single families, detached properties, and resales only. Okay, so this is, I'm not comparing new construction or all that, because that'll throw your data off, right? So if you look at the market in general, if you compare, say, Streamwood to Midlothian, right? Streamwood was a higher priced market when it started. So we're going back as far as 2008. In general, the markets all came down somewhere around 2012 or 13, and this is what I was talking about. Now, there were more sales in 2012, there were more sales in 2013, but the pricing didn't start rising until the middle or later of 2013, going into 2014, right? So that's something that you have to kind of look at, is that where was the pricing? So if you look at today, where's the pricing in Streamwood on an average for a single family property, even at, say, 212,000 or 140,000 in Midlothian? And now if we go back and plug this into a, like say a rental calculator, is that if, let's say somebody's buying a property. Now for a rental, typically you're not gonna buy on the high end of the market. You're gonna buy probably on the low end of the market. So let's just say I'm taking a high end, you're buying say a 3-bedroom, 2-bath property, 190,000 in Streamwood, right? And the rent is about $1,700 bucks. Does it cash flow? Even at these numbers, now this cash flow is a little bit lighter because we like the break-even points here to be somewhere around 75% or below. But still, it'll cash flow, and the banks will continue to give you loans. Why? Because your debt coverage ratios are above the 1.44. So if somebody buys a property as an investment, they're going to consider, the bank is going to consider this property a good quality property. Now, how does this number change? If this price, let's say goes, let's say this price goes to 220, the same property, right? What you'll notice is that your there we go. Okay, so your numbers will start. Why is this? Okay, so here we go. Now what starts happening is that if you look at the property is 220. Now to buy this property, if you put $25,000 down, you have $55,000 investment. And guess what starts happening? Your debt coverage ratios now, suddenly the banks may start looking at this at a 1.3 or so debt coverage ratio and say, we're not sure. So until what my point is this, that until in whatever suburb you're investing in, until you reach the threshold where the affordability, especially as it comes, we're talking about from a rental perspective, doesn't reach the threshold where your cash flow no longer supports your investment. Till that point, in general, in the market is going to remain stable. So I hope that makes some sense. I hope some of those thought processes make some sense. The next piece of this is we're going to start adding how do you take, so then the second thing becomes is that how do you take a market, so let me go back here. Okay, so how do you take a market, and if you're going to, let's say, look for properties or markets to flip in, right? How do you compare the markets? What are the markets that make the most sense, and what is going on in those markets? So next time when we go through it, what we'll do is we'll take some of the markets, let's just say some of the markets up in North Shore, the Northbrook market, the Lake Forest market. What are the markets? What are the total number of sales? Now, mind you, it's going to vary if you find a property. Let's just say it's in Lake Forest. You know Lake Forest back and forth. And I'm just using that as a lot of people know where the suburb is. So I'm just using that as an example. But the property is an incredible buy. If it's an incredibly good buy, then it makes sense. So I want to show you guys something specifically about Lake Forest, because this is kind of rather interesting. So I'm going to take this out and take this out, make this Lake Forest. Here we go. So if you look at Lake Forest in general, what has happened is obviously from 2008 to today's pricing is much lower than obviously where it was, which is no surprise. Yet in Lake Forest, once the property prices started coming down, they really, in relation to where they were, they have not come up as much as they have, say, in certain other suburbs, right? If I compare that to, let's just say, well, let me see, if Northbrook, because Lake Forest is a higher priced area. Okay, there we go. So if you look at it in, let's say in Northbrook, right? What happened was the effect of the pricing was a lot different in 2008 versus 2013 versus 2017. So that's a market which makes, it's a nice trough. It makes sense to invest there because you know that the market has come back and the prices in general are going to keep increasing. Now, if it's a flip and if you buy it at the right number, it's not going to make a difference. But these are factors that you need to consider. So to conclude all of this, to me, if you look at the Chicago market today, the affordability is still there. And because the affordability is still there, you are going to be able to have a stable market. Now, that this is just in the short term, not in the long term. I don't feel yet The economic factors are such because the qualifications for mortgages in the last 4, 5, 6 years have been very, very tight. So not as many bad loans have been written. And so unless some catastrophe happens, if some catastrophe happens, there's nobody that can, say anything about it. But if otherwise, what will happen is that it will, in general, it will have stability in the general area. So hopefully some of this stuff makes some sense. Some of these are just thoughts, and mind you, this is not, it's not right or wrong. Some people may disagree with it. This is just my personal feeling is that still in the Chicago market on the whole, we are in a stable situation. The $1 million price range and the big rehabs with the add-ons, I think that's where people are. There's two downwards pressure. Number one, the number of buyers in the $1 million price range are lower. Number two, people are not buying as many McMansions as they used to before the recession happened. That's the other factor. And then the third factor for properties, whenever you're buying a property and putting a second story on, the pricing itself to buy the property, by the time you add the second story, pay for the labor, because the labor has gone up in the last 5 or 6 years to about 15 to 18%, that has a significant difference in your bottom line. So we'll kind of discuss all those issues in the next recording. Hopefully some of these thoughts made some monochrome of sense to most of you guys. I see there's still 100+ people on the line on the webinar. We have recorded it, so we will send it out to you. Thank you again for attending. Those of you guys that haven't registered for the 3-day, please register. You can go to chicagocashflow.com and register. The cost is only $39. It's on the 16th, 17th, and 18th. So wish you nothing but the best. Look forward to seeing you at the next RIA meeting. Thanks a bunch, and have a great day.